All right, so we are live. Appreciate you joining us. So here's a new word, hurricane. So Southern California. So not only do we have a hurricane, first time since 1939, we have a hurricane that's hit us, and it's vestiges of a hurricane, Hurricane Hillary, and we just had an earthquake, a 6.0 up in Ventura County. Um, so there's a new word, hurricane, and I don't know who coined that, but I thought it was pretty good. So, first time to channel, welcome. We appreciate you joining us. We make videos at all things Southern California. What's it like to live here, work here, play here, owning a home here. Certainly, we're going to be talking about a ton of things tonight. If this is your first time to channel, welcome. Certainly, click the subscribe button, hit the bell for notification. We'd love to notify you the next time we make a new video about Southern California. And I'm a licensed real estate agent. So whether you're looking to move here, move from here, or invest here, so give me a call, shoot me a text, send me an email, set up a Zoom call. We do lots of Zoom calls. We'd love to help you with whatever your real estate needs are. So tonight we're going to talk about a wide range of things. I love numbers, and our son is kind of a savant when it comes to numbers. So we play all kinds of numbers games. But tonight we're going to talk about numbers. We'll talk about the macro, we'll talk about micro. We're going to go over the local real estate market. I think you're going to get a lot of great information and insight into what we see on our end. And I consider it very important to keep up on the economics because it does affect the real estate. So let's go ahead. With that said, let's go ahead and dive in. Let me share the screen, and let's head over, and let's go over to this one. So in a bid to finish off inflation, Fed raises interest rate to 22-year high. 22-year high. And so what we're seeing So what we're seeing is not only are interest rates high, but we've seen, of course, record inflation. We had the worst bond market in over 40 years last year. The stock market's starting to take a hit. As a matter of fact, the gentleman who was the gentleman the movie The Big Short was based on put approximately a $1.5 billion bet against the market. So I guess we're seeing more of the ad. I apologize for that. But here's the article, so Investopedia. So 40-year high inflation, interest rates at 22-year high. What the Fed's trying to do is control the inflation rate. There's a wonderful interview with the lady Danielle DiMartino Booth. Now Danielle was I'm sorry, what's that? So Danielle, sorry about that. So Danielle was an advisor to the Federal Reserve down in Dallas, and then went to work for Warren Buffett and Charlie Munger over at Berkshire. And she had a wonderful interview. She talked about Jerome Powell. She talked about what the Fed's looking to do. She talked about all that, and the net effect. Let me go back. Let me stop sharing. Sorry about that. It's kind of loud. The net effect is that, and she talked about this, the Federal Reserve's lying to us about inflation. And people talk about that. Sorry, we're still trying to work out some of the bugs on the way we screen share. Sorry about that. But she really likes Jerome Powell. She thinks Jerome Powell's trying to do a lot of unique things to Fed. But she talked about inflation, and I made a little video about that. And are you going to believe the Fed and the government are your own lying eyes? And I say that because we know when we go shopping, it costs more. When we fill up with gas, it costs more. When we charge an electric car, it costs more. Everything costs more. Gosh, look at the price of lumber, what we had. Look at the price of eggs. Everything has gone up. They're talking about out here in California raising the minimum wage to $25, and they're even talking about going to $30 for certain service workers. and I just don't know how that's gonna be tenable for a lot of people. Certainly, a lot of smaller businesses is going to be very interesting. And I belong to some unions, and I think certainly they have their place. I think though, when it comes to pushing numbers like that, these small businesses are going to get hit really hard. And so it's gonna be interesting to see how that plays out. But Danielle talks about Danielle DiMartino Booth, but she talks about inflation, and she also thinks that it's higher. And she talked about where she thinks the markets are going. And I want to talk about some things that she talked about and expound on them. One thing she talked about was biblical um, downturn in the commercial market, and we're seeing it. We're seeing a lot of defaults now in the commercial real estate space. We've seen it in San Francisco. We've seen it in Los Angeles. Certainly New York. And I've touched on this, that people want to feel safe when they go to the office. There's a building named after Pelosi. It's a federal building in San Francisco that the HHS, Health and Human Services, has a lot of space in. They've now encouraged their employees not to come to work. So you have federal employees that are not going to work at a federal building because they don't feel safe. It's kind of an oxymoron, if you will. But it's interesting because San Francisco has seen a 67% decline in cell phone traffic downtown. So the question is that the canary in the coal mine? And is that the leading indicator? Is that the first thing that people see is decline in things like that? We know for a fact if you don't have the foot traffic, you don't have the traffic, you're not going to have people stay in your hotels. They're not going to shop. They're not going to go to a sporting event. They're not going to eat there. They're not going to do anything. So we've seen a huge decline. Certainly prices are, we've seen some 75% haircuts. So you can buy a building, let's say a building was 50 million last year, and now you could buy it for 12.5 million. So 1/4. That's apocalyptic numbers. What it's affecting, it's certainly affecting banks, and more the regional and the local banks. The big guys, what's interesting, the Chases in the cities, and Wells and B of A, are there to scoop up the little guys as they're failing. And it's really interesting to see. Again, yeah, too big to fail definitely applies. But what we're seeing is we're seeing the commercial market now. The question is it going to drag down the residential market? Not so certain. We'll talk about that. But on the commercial side, just be aware that it's being affected. It's being affected by the interest rates. A lot of them have shorter. Most all of them have shorter terms. So you have 3 to 5 years. Now there's ways you can buy hedges. You can, but a lot of people don't buy the insurance, the hedge insurance on, because it's expensive on the rate. So if you had a 3.5% rate 2 years ago, and now you're at 7 or 8%. You've doubled, and now you have debt service coverage. How are you going to service the debt? Typically, banks like to see a debt service coverage ratio, DSCR, of let's say 1.2. So if you have a $1.2 million loan, if you have 1.2 million, if you're servicing 1.2 million debt, and there's $1 million coming in, you can't service it. You'd need to have 1.2 million coming in to service $1 million, not the inverse, if you will. So we're starting to see banks, they're trying to shore up their balance sheets. The Fed's helping them. We expect a lot of government money to flow in the banking industry. But I think that's a really big deal, is the commercial. And again, we are really seeing some big numbers there. We're also seeing, because of inflation, there's a really good inflation calculator, and let me share, see if I can do it better this time. We'll do a share screen, and here we have an inflation calculator, and this is really cool. Sorry, we should I get to it sooner. So if you were to buy something today, what would it have cost? How much more would it cost than 2020? So it's 18%. So let's go back 1980 to 1990. So remember the huge inflation years. So let's go 2016 to 2020. Those are big numbers. So just in the past few years, let me go back. So has inflation, has it had a big effect? Yes. What we have is, let's go to 2020, 2023 again. So we're for 4 years, we were 7.8%. Now the past three, we're at 18.1 for an effective a little bit over 6% a year. So it is without a doubt affecting, no doubt that that's affecting a lot of people. A lot of discretionary income. Discretionary income has been on the decline, and so there's less discretionary income. Consumer debt, the household consumer debt, credit cards is over $1 trillion, first time ever. And again, a lot of people are still living paycheck to paycheck. Now, I don't want to be quote unquote a Debbie Downer. There's a lot of good things to like also. Employment, the employment rate is still low. We have good participation rate, but we have a lot of loan programs for people that can afford a home. There's a lot of great loan programs. You have low down, of course, for VA, you have no down. We had a lender call us today. They've got a new 3.5% loan program. So you can go FHA, you've got VA, you've got USDA, you've got Chinoa Fund, which is a tribe, Indian tribe. There's a lot of cool things. So there's a lot of, and out here in California, it's called CalHFA, and most states have a special program. They want you to buy a home because they know that wealth is created many times, most people's wealth through real estate, but also they want, because they're going to get the tax revenue, and there's more tax revenue if someone owns than if someone, of course, rents. So that's one of the things they're looking at. So those are two of the things we've looked at. So looking at, I'm going to close these. So looking at the interest rate, and then looking at the inflation. Let me go back. Those are, those are big. Let's look at housing starts. We're starting to see builders, they're starting to increase their builds, the number of units they're adding. But they're not keeping pace with private building permits. So for builders, that's up approximately 0.6% from last year. But for private homeowners, it's up 18%. What that tells me is that people have decided, I'm going to stay in my home. I have a low rate. I like where I live. And they're just going to go ahead and add on. They're going to add an accessory dwelling unit, certainly out here. You have ADUs, junior ADUs. Think of them as granny flats. So they're converting a garage for people to live in. They're going to rent it out. Some people are going to add a second story. That's a big deal, because when we talk about the real estate market, it comes down to right now, not just affordability, not just the bill. It definitely comes down to the inventory. Now, let me show you that. So let's go over. I want to go over. So we have. Let me go right here. Here we go. So this is a market snapshot for Orange County, and as you can see, the average price has gone up. The number of properties sold has declined. It's not a sales problem. It's an inventory problem. If we have more homes, we'd sell. Average days on market has gone up. That always intrigued me. I was kind of befuddled by that. But the average days on market, they say, has gone up. And I really attribute that to a few things. I think certainly affordability. People are taking longer to close. And so, but typically, in a low inventory market, you'd see days on market down. New listings down 30%. But the month's supply of inventory is down 13%. But the new listings are down 30%. Less number of homes are coming on the market. I've talked about this before. We've had offers on my listings here in Orange County. We've seen hundreds of people through open houses. I've gotten 20, 30. I one time I think I had 140 offers on a property. Goodness gracious, that's tough to sort through. But we're putting offers right now on properties even as far as Riverside, and we're seeing 30, 40 offers. I'm not trying to scare people. There are ways we're getting homes, but just know that right now it's an inventory problem. So when homes come into market, a good home priced well will always sell. A good home in 2008, 9, 10, the market was tanking. We had short sales. We bank owned a lot of REOs. I've done them all. Short sales, REOs, probates, all those. It's a lot of experience. Reach out to us. Have any questions? But what we saw is that good homes were priced well, still sold. And that's what we're seeing right now. Good homes priced well are selling. Homes that need a lot of work are also selling. So we're still, it's a market that is being defined by lack of inventory. No ifs, ands, buts about it. So, that's that one. But what I really thought was cool was the housing starts. Now the builder confidence index has started to creep up. They were down for quite a while, but it really is going to depend on what the Fed does. Fed's driving certainly the mortgage market. Again, there's lots of down payment assistance programs. There's lots of great loan programs. We have a great list of lenders that we can provide to you. If you have any questions, reach out to us. We just got a call today from a lender about an I-10 program, which is for foreign investors. They also have 3.5% down. So the lenders are coming up, and the funders and originators and the banks are coming up with all kinds of creative programs to help people afford a home. So we know that the prices are high. Let me throw something at you though. Prices are high. Interest is fairly high. Historically, it's really not that much higher than we've seen in the past, average past 20, 25 years. But what we're seeing is a holistic approach to one's finances. What I mean by that is this. Let's say you have $20,000 in credit card debt and you're paying 19 to 29%. This credit card debt's high for the most part, for most people. Let's say you're paying 19%. Let's say you're paying 11.5% on your car. And let's say you have a student loan, and maybe your daughter, son, or husband, wife, or someone had to get braces. Heck, maybe your pets. Maybe something happened with them. But you've got this $20,000 in debt at a high number. What we're seeing is the lenders say, hey, what we can do is you have equity in your current house, so you sell. What we do is we take, and in your current loan, we make certain to pay off the old debt. So now you're getting all this credit card debt paid off. Now you're getting the veterinarian's bills, you get the dentist bills, or the dentist, all these bills paid, and you're getting it at a lower rate. So your number can be lower, even though you might be buying more home at a higher rate as far as your current mortgage rate, but your payments are down. Call us, let us know. We can work the numbers for you. We love doing that. So what we're seeing, people, there's lots of different ways to afford homes. We also have something called a perfect home finder. Reach out to us. What we're finding is that some people, they're looking for a home. They're not seeing it on the multiple listing service. They don't see it on the other internet sites. The multiple listing service, by the way, is where agents list properties, and they go out to the syndicated, and they go out to Realtor.com and all the other sites. So that's why you're seeing the same things on thousands of sites. It's just packaged differently. But what we do is we find homes that are not yet on the market, and that right now is a big boom. We actually actively go out and help you find the home. We need a lot of information from you, but we'll go out and find you the home. There's lots of different ways we do that. Set up a Zoom call with us. We'd love to talk to you about that. So as far as selling, we've had God's blessed us with a very good track record of helping people achieve top dollar when selling. So same thing, if you're looking to sell or buy, certainly reach out to us. We'd love to help you. Let me touch on something else. Let me share the screen with you. And this is Consumer Price Index. I thought this was really cool. So here you can see, and this is the site called U.S. Inflation Calculator, and that's why I had the earlier calculator. But you can see all this data. So so this talks about the CPI, and they talk about the Consumer Price Index. And they talk about how to figure it out. And they show you the 12-month change for the major categories. Look at the fuel oil, unbelievable, and electricity. Hey, we're getting down, in the winter back east. We don't use fuel oil that much out here in California, but back east they use a lot. If you're back in New Jersey or Connecticut, you've got the big tank. You know how that works. So these numbers are huge. But look at the differences. So 1913, not so much. But goodness gracious, look to the right. There's the average 1%. Yeah, they ticked up. We had the crash. They went down. But this is really, really interesting. Let me move forward. Let's go to 2010. Even 2009, we're coming out of the recession, if you recall, 2010, then with 2011, we're hovering around 2.5%. And all of a sudden, 2021, 2022, we saw this huge jump, 4.7%. And then we saw 8%, which if you go back, you had to go back to 1981 to see a rate that high, inflation rate. Personally, I still think the rate's over 8%. I think we just get that just naturally because of how much it costs to, for groceries and also how much it costs to fill up a car. But and of course electricity and things like that. But these are big numbers. These are numbers that affect people because if it's 8%, and the simple way that I figure it out is if you spent $1,000 on groceries last year, you spent $1,080. As a matter of fact, I've heard that the average family in the past 2.5 years is spending $722 more on average in food and monthly food, electricity and things like that. So these are big numbers. That affects discretionary income. That also affects the ability of one to pay down credit card debt. That's why we're seeing a spike. Credit card debt is over $1 trillion. We're starting to see home equity lines of credit. We're starting to use those. You're starting to pull them. Banks are starting to limit credit and the credit supply. So again, all of this, you throw it in the pot. It really is interesting. It's going to be really, really interesting to see where we get back to. Inflation, big driver, definitely. Interest rates, big driver. The fact that people are staying home and they're not selling and they're adding on to their home. And 18% of people, there's 18% increase in permits pulled by private homeowners versus permits pulled by builders. Builders are up 0.6%. And what that's telling me is that more people are willing to stay and upgrade the home they have, add an accessory dwelling unit at second level. Maybe they can reconfigure that 4-bedroom to a 3-bedroom with a bonus room. Maybe it's a den, maybe it's a family room, maybe it's a home theater. Kids as they go off to college. So we don't know, but it's a lot of really cool stuff in play. So the macro, the micro, and of course the real estate market. Hope it's been educational. Love. Again, these are numbers that we love. And if you're looking to make a move, whether you're looking to buy, sell, relocate to Southern California or from Southern California, give us a call, shoot us a text, send us an email, set up a Zoom call. We love Zoom. We'd love to help you with your next real estate need. Have a great evening.